I wanted to come on here and at least give a little bit of my insight and thoughts on what I'm doing kind of with my portfolio right now, just given all the environment and everything that's going on. I do not believe in market timing, whether it's like be in the market, out of the market, like with your, long-term kind of retirement stuff. You pretty much just stay allocated the whole time in there. This is more in reference to like if you have a separate brokerage account, tactical kind of account where you're owning individual stocks with things at all-time highs right now, having a huge, what do we call it, like 30% run from the bottom in April. My portfolio specifically having a lot of embedded gains. The first thing that I do is I'm trimming as things are going up. I'm locking in profits. I invest in small cap, so those things are a lot more volatile. So you could be up 30%, then down 30%. I'm not talking about penny stocks. I'm talking about 2 to 10 kind of billion market cap. It's more important to take profit on those because not all those companies will grow to be, large cap or even mid cap. With things at all-time highs, because I'm a little bit more sensitive on kind of valuation, and I'm a little bit more cautious when it comes to position sizing. Whereas when you have a big dip kind of in April, I'm able to be aggressive on names that I like and really upgrade my portfolio. Things that I have that are high growth, but I know I'm getting at good valuations. Now you've seen this big run up, and assuming a lot of those runs are driven through earnings growth, you don't necessarily have to see a lot of multiple expansion, but a lot of times that is part of it. Really, it's more with new positions. Make sure that you're not initiating something that's run up 50% at a super high valuation. You want to make sure that the price to earnings, the price to earnings growth, the price to sales, is reasonable. I am building up a little more cash, knowing, hey, a lot of these things have run quite a bit, and I am not seeing a whole lot of things that from a valuation standpoint that I'm like, I have to own this right now. There's a lot of growth out there. There's a lot of things that I would love to own, but I am a little bit more valuation sensitive because I do play in the small caps and I do play in the higher growth names. So I want to make sure like I'm getting it at a reasonable price and I'm not going to buy it and then we're going to see that 20%, 30% pullback. I usually like to wait for either that pullback or something in the business, whether it's a piece of news or something for the business to stub their toe so that I can get it at a bit of a discount, just building up cash to kind of be ready for those opportunities when they do come. I wouldn't say full cash. I would just say a little more cash than I was running, obviously, throughout the year when, there were plenty of things on sale and plenty of things that I wanted to own that I saw with, 2-3x upside. So to recap, basically, trim the things that maybe have higher valuations after this big run, build up a little bit more cash, and when initiating new positions, be mindful of the valuations of those, be mindful of the fundamentals. Do the fundamentals make sense for this valuation? Like, are they growing and can they justify 32, 35, 40, 50, 60 times earnings? Or, are you going to be paying the peak price and it's ready to kind of revert? This is not me being bearish. I'm actually pretty bullish on the market. I think with the whole interest rate cut coming, that's going to be very beneficial for small companies. It's going to be very beneficial for long duration growth companies. And so that actually makes me optimistic and want to purchase things that are higher growth, and even on the smaller cap side where it's harder to access capital and they're going to be able to get more capital. The reason that it's beneficial for these long duration companies is because a lot of the times those companies have to use leverage to continue to fuel growth for their business. And so being able to do that at a lower interest rate is going to benefit those companies. When you see interest rates rise, you see growth companies get hit a little bit in the market. It's just balancing the optimism and bullishness of the interest rate cuts with, hey, we just had a big run, so let me be a little bit more sensitive on price and not get too aggressive, and just kind of patient, waiting for your opportunities. again, just in the tactical portfolio. The other thing would be shifting a little bit more into defensive sectors. Just make sure that you're being defensive kind of in your approach in these times with position sizing and maybe the types of companies that you're investing in. So from a sector standpoint, I would move away from more cyclical companies, look for more stable companies throughout the year, industrials, business services, and then use position sizing as a way to manage risk as well. You can use diversification too. So for position sizing, maybe I would take X size position. I might take a half size position and wait for a pullback. If I'm anticipating maybe it's a little higher valuation or there's some uncertainty, and then be able to add to that. Also, you can use diversification, even though I think if you know the companies you're investing in and you have a high degree of conviction, you don't necessarily have to use traditional diversification rules, but to each his own on that. And you can use that as a way if there is more uncertainty around whether you're getting a good valuation or if there's going to be, an outsized impact by one company on your portfolio. That would be my approach. All right, so after watching back my video, I want to give a little more context. So the overall market is up like 10% this year. That's the broad indices, but a lot of these names from the April low are up well over, like 100%. Like Nvidia was at like $80 or something then, and now it's, closer to 200, it's like 180. But anyways, and even over the last month, the small caps have run 7%. Small caps are nowhere near all-time highs. They haven't performed very well over the past several years, but tons of individual companies have done 200-300% this year. Some of those I've owned. And so what it ultimately comes down to is picking and choosing your exposures. So the overall market is typically valued at like 22 times earnings. And the earnings growth is like, I don't know off the top of my head, but maybe let's call it like 8 to 10% earnings growth. So just 8 to 10% earnings growth should yield you, 8 to 10% return over the long term. But what happens is multiple expansion. So like the market trades at 22 times earnings. Faster growing companies can get multiple expansion, which means they are trading at 30 times earnings, 40 times earnings, because their expectations that their earnings are going to grow faster than the overall market. And therefore, like if you have a 50 PE, 50 times earnings, and your earnings are growing at 100%, that means by next year, those earnings, you're only going to be trading at 25 times those earnings. And so that's kind of what the high valuation means. So you just want to make sure you're picking companies that the earnings match the multiple. The earnings growth matches the multiple. And it's more of like a short-term thing, right? There are plenty of things in the market that have reasonable valuations. You just have to find them. There are a lot of companies that have really bad valuations, and you need to pay attention to that. They're 20 times sales and have no earnings, and they have AI in the name, and so they've gone 3x, 4x. You need to know what you own, basically. That's what it ultimately comes down to. And I have a couple companies that have gone, well over 100% in the past year, and their valuations have gone up. But since I bought them at a very good valuation, it's not something where it's like I need to completely get out of the position. I just need to reduce my exposure because I don't want as big of exposure to this company at this valuation. At this valuation, I might only want half this size. Plus, most of it is going to be growth on my original investment anyway. So I can take my original investment out and I can use it towards something else that looks attractive from a valuation standpoint, has the characteristics that I need to, for a new investment. And so it's really just, there's always this constant churn in the portfolio and, finding new ideas. And, I have a list of companies that like I love and love the businesses. but I just need them to be at the right valuation, or, some of them kind of grow out of the small mid-cap space, and then I'm not really as interested because the growth starts to slow. They're larger, more mature businesses, and I prefer more, smaller, faster growing businesses that kind of can hit that inflection point. It's not uncommon for a lot of these companies to go, 3 to 5x in 3 years, whereas, sometimes your larger companies, like, they're probably going to go anywhere from 1 to 3x over 5 years. So that's just kind of a little bit insight into why I choose this area, why my approach is what it is. And I can go deeper into that. And so it's really just more the small cap area in general just had a really strong run over the past month, and I need to spend more time coming up with which companies right now do I feel like have a valuation that I want to invest at this level. And it's not uncommon for, after a really strong month like that, to start seeing a little bit of a breather in some of these companies. And that's where I'm going to have cash and be ready to deploy into those names. I by no means got rid of every single investment that I have. I'm just, taking some of the gains from those companies and being more on the cautious side, expecting a little bit of a breather at some point. What else did I need to kind of explain? So there's a difference between specific companies and just the overall market, because the overall market, I wouldn't say the valuation is extended by any means. I mean, 23 times earnings with the 10% earnings growth is not unreasonable at all. And it's really just, select pieces. So if you own individual stocks, just make sure on that. And what else was I going to say? Something about small caps. So this is a little bit more into why small cap stocks versus large cap stocks. This is not really my investment approach, but this is a little bit of why I focus on small caps. So there's such thing called sell side analysts, at your big investment banking firms, or not investment banking, but you're like a Morgan Stanley, Goldman Sachs, JP Morgan. They all have sell side analysts who cover names in the universe, in the market. They give them ratings, whether it's a buy, strong buy, sell. They put out price targets, which are always way lagged from the price it's actually at. They're late to the game all the time, and it's BS. The sell side analyst thing is BS. But anyways, for Nvidia, there will be like, 100 analysts at these different firms that cover Nvidia. So there's a lot of eyes on it. There's a lot of calls with the management team. There's a lot of, like, everyone knows what's going on pretty much. And the expectations are pretty much in line with what results are typically. And there's very little room for, like, opportunity for the market to not see what's coming. Obviously, nobody could really anticipate this whole huge AI boom and what it's kind of grown into, but there's more inefficiencies in smaller companies, because for these small cap companies, a lot of the times there aren't even any sell side analysts covering them. Zero. And if there are, it's maybe 1 to 3, and they're at really small no-name firms, and they just put some price targets out there because that's what they do, and they put a neutral rating on it and whatever. So there's not a lot of people looking at these companies, figuring out, is this company, growing faster than we think? And that's what creates opportunity in the market, is when there's a difference in reality versus what the market thinks, because the market thinks is a forward looking mechanism. So it's all about what they expected. If they obviously it goes off of multiple of earnings growth, but if the market expects this company to be growing faster, it gives it a higher multiple. If the market expects this company to not do very well in the future, it will give it a lower multiple and lower expectations around that. So what you can find is there will be a company that trades at this and they're actually worth this, and if you have a different view on where the company's going, you might actually think the company is worth this. So
not only are you able to buy it at a discount to what it's worth now, but you also think their future growth is actually better than the market thinks. And so you're going to get it, and the price target's going to be up here. So in small cap, because there's not as many eyes on these names, there's more inefficiencies in that market. And so it creates more opportunity for you to actually, and like, for example, a company could start to grow and they could be doing well for 3 years and the stock price will go up, but people won't even recognize, hey, this company is growing at this rate. Like, it'll take them 2-3 years for you to even realize, because there's literally, in the small cap universe, there's 2,000 companies, and probably well over half of those have no sell side analysts covering them, let alone, it's mostly just money managers and people like myself who do the due diligence, who sit there and read the financial statements on the weekends and at nights and listen to the quarterly earnings calls because they want to understand these businesses. And very, very few of them actually grow to be large companies. That's just the reality of it, because they're a lot of the times they either get bought out by other big companies and tucked in acquisitions, or their addressable market for the business that they are in isn't big enough for them to make enough money for them to get to that valuation. So a lot of the times the best that they can do is, go from like a $2 billion company to like a 15 billion. If they do really, really, really well, they catch some inflections in their sales, and they catch some really good earnings growth through, operating leverage and that type of stuff. And they also need to have a big addressable market. So it's like a company that is low capital intensive, like for software example, companies that sell software, that's not a lot of overhead costs. They don't have to hire a ton of people, and they can just sell their software, sell. So it's all margin, it's all profit. That company can grow a lot better than someone who needs to go out and hire a bunch of people to build a bunch of houses. And, especially if you're starting small, a lot of the bigger, developers, real estate developers, will buy all these small ones up and bring them under their company. But anyways, small cap, inefficient. It's usually where the faster growing companies are. That's why I like it. Mid cap can be good too, because you're starting to get into, mid cap would be like, in my opinion, around your 10 to like $30 billion range. And that's where you're getting into slightly more mature businesses. They're going to be a little more stable. They're a little more predictable. But that also, means that maybe they won't have as much upside surprise in earnings growth or sales. Plus they start the law of like large numbers starts to happen. It's like you can only grow at a certain rate for so long before you need to have so much revenue or so much earnings that it starts to hit a wall. And so, but those companies can offer more in a portfolio from like a stabilized standpoint and all that type of stuff. Plus, like, for example, you think about like Warren Buffett and all that, like he has so much money, he can't even invest in these companies anymore. But this is where he started, because he was able to find differences of what the companies were actually worth and what they were trading at, right? So just because a company trades at a certain valuation doesn't mean it's actually worth that. One example could be some of the parts. It's basically if you took everything from the business, goodwill, tangible assets, all the, appliances, all the chairs, everything that they do and have, and you sold it all off, what would the sum of that business be worth? And if the stock price trades below the sum of the parts, then you're getting it at a discount, and then you're arbitraging that. Eventually the market will realize it's worth this, and you will get the difference in that return. There's other ways of valuing companies, based on their growth and all that type of stuff and where it should be at. But that's a very simple example. And we'll just leave it at that. I feel like it was a little bit hard to explain that I'm not generalizing the entire market as having a huge run up. I'm talking about a specific area, specific types of companies. And so there's always other opportunities. It just might not be in some of typically you have to shift areas, right? Okay, so for example, you know, real estate has lagged right now and it's not a great, you know, time to be in real estate. So that would be an area where you could find really good value. You just might not find a whole bunch of growth. So there's two different types of investing style. You can do value or you can do growth. I like to think of my philosophy as more of like growth at a reasonable price. I'm not just willing to buy anything at any price, no matter what, you know, if it's showing momentum. But I would say I do stretch that limit a little bit. Like I have no problem buying something that's 100 times earnings if the earnings growth is 150%, and next year they're trading at 30 times next year's earnings. You know, to me, that's crazy growth, and the stock price is going to appreciate on that as well. So it's all relative too, but yeah, now I'm getting too into the weeds of the investment approach that I take, but just needed to give a little more color there so it makes sense of why I'm saying the things I'm saying. Because yeah, you look at it, it's like the market's only up 10%. You're thinking, what's this big run about? And it's really just specific companies. Like even I would say Nvidia, you know, Nvidia trades at 60 times trailing 12-month earnings, and I think maybe 40 times next year's earnings, and they just beat earnings really good, and the market kind of seems like it's like, you know, so I don't know. I mean, I'm not saying I'd go out and buy that right now, mostly because you're already getting a lot of that exposure if you have a diversified S&P 500, you know, ETF, or if you're invested in the US stock market in general, you're getting 8% of Nvidia. So, but anyways,